Hi guys, welcome to my channel. So today I will explain how to use moving average as your support line. So moving average is basically a line that tells you the average price traded in a specific time. Okay, so usually I use 7 SMA, 10 SMA, 20 SMA, 50 SMA, and 200 SMA. As you can see here. So let me explain how each all of this simple moving average works. Okay, just imagine 7 days simple moving average. I'm using SMA, simple moving average. I'm not using EMA, which is exponential moving average, but that's okay. In this video I will explain about simple moving average. Okay, so just imagine 7 days simple moving average. If you want to know how it works, 7 days moving average, just imagine it like a 7 layers of papers stacked together onto each other. So that kind of surface made of 7 layers of papers is quite thick but not so thick. Okay, so if you take a knife and try to step step into the layer, it will break. Okay, it will easily break. And same goes to 10 days moving average. Just imagine it is a stack of paper of 10 layers of papers, and you step the knife onto it. It's getting a little bit harder to break, but eventually it can break. And then same goes to 20 days. It became harder to break, but if you push with enough force, it will break. And then also 50 days moving average, 50 layers of papers stacked onto each other, and when you try to step the knife onto it, it's become harder to break. If you push it a little bit more with higher force, and it will break. And then the last one is 200 days moving average. Okay, just imagine this like the other 200 layers of papers stacked onto each other, and you try to break it with the knife, and it's getting very hard to break, but with very high force it eventually break. So this is the line on the chart. As you can see here, the gray one is 7 days moving average, yellow is 10, red is 20 SMA, green is 50 SMA, and turquoise is 200 SMA. How are we going to use this as our support line? Okay, so this example here show how the price can easily break on each of this line. Okay, when the value getting bigger, the harder the price need to the bigger the force the price need to break this line. Okay, so that's why I'm telling you how to use the moving average as a support line. So if the force is not big enough, usually the price can bounce back. It will not going to break the moving average line. Okay, this is the tiniest one. Okay, the 7 days moving average. So if the force is not big enough, the price will bounce back. If the let's say the volume is quite big, it can easily break, because this one is the smallest number, and same goes to 10 days. Okay, usually if the volume is not quite big or the momentum is still there, the price can easily bounce back on the 10 days moving average. Sorry. Same goes to here. This one needs more force or bigger volume to break, but if that's not enough, the price will eventually bounce back. And same goes to here. This is the best way to make it as your support line, and 200 moving average as always the thickest one, so the hardest to break. Okay, let me show you some example on the chart. So if you can see here, this one is IonQ. Okay, in this chart we can see that the indicator I already put over here. Okay, if you wonder what line belong to moving average, so the gray one is 7, the yellow is 10, and so on. Okay, so if you can see during the stage 2 here, wait one moment, never mind. Okay, this during the advancement, the stock rising, okay, the price usually bounce on 7 days or 10 days moving average. So if you are going to enter a position on this particular stock, you can consider to enter around 7 or 10 days moving average. Okay, because most of the time the stock will bounce on this level, on 10 or 7 days moving average. So you can do it as your support line. You just have to wait the price to come, and you enter around this area. This will be easier for you to place your stop loss. Usually I will, if I want to enter around here on 7 or 10 days moving average, my stop loss will be below the 7 days or 10 days moving average, because once it's break, it might continue going down, as you can see around here. Okay, that's the example for 7 or 10 days moving average. Usually the stock that bounce on these two moving average has a very fast pace of growing. It will give us a good chance to earn some profits in quite short time, but just be careful, okay, because that is not my favorite place to enter position. So let's go to 20 days moving average. Let me find something that can shows that the price will bounce on the 20 days moving average. Okay, let's see this one. In Aurora Innovation, during September up to end of October last year, 2024, the price has rise more than 60%. Okay, so during this stage, okay, if you can see, the price is actually bounce on 20 days moving average, the red line here. Okay, once it goes up and then it stay above the 20 days moving average, this is a good sign or a good place for us to enter a position, because we can see clearly the price never been close below the 20 days moving average. Okay, so we can enter the position here and put our stop loss just below, but also be careful, right? In this one the price did go straight down and then eventually close above the 20 days moving average. Okay, that's around here, it's still close above the 20 days moving average. That's how you use it, because 20 days moving average is you can easily spot a chart that are going to bounce on the 20 days moving average. Okay, let's go to 50 days moving average bounce. I have a few example here. If you can see, this one is also bounce on 20 days moving average. Okay, if you can see around here, the price break the 10 and 7 days moving average and eventually bounce back, and here clearly the price bounce back and making a huge advance at this level. So 20 days moving average is quite tough, and usually the price that bounce back have a good momentum to continue rising. Okay, let's go to 50 days moving average. I think I have few examples around here. All right, this one, let's see some more example. Okay, we go to this one, Amazon. Let me delete this thing first. Okay, this was from my previous video. I explained about the parabolic pattern. You can watch it. I think it on the Cisco video. Okay, this one is an example for 50 days moving average. This is by far, from my own experience, is the best place to enter your position, and it has very big potential on the upside. Okay, let's take a look around here. This green line is 50 days moving average. Okay, every time the price come close to the 50 days moving average, it bounce back, and also this time it bounce back. So you can use this level to be your entry point, and you can place the stop loss just below the 50 days moving average. If the price break the 50 days moving average and hit your stop loss, don't worry, it's okay. The price might go lower, so you don't have to worry about it. Your stop loss is just right. Okay, in the next video I will explain how to use all of this SMA as your indicator that the stock is going down. Okay, so again, around here the price break the 20 days moving average, and eventually it goes back up. Okay, almost close to 50 days moving average. So you can use this as your indicator or your support line. Once you see the price bounce back, the first candle bounce back, you can enter the position. This is what I always use. Okay, so if the stop loss just below the green line, the stop loss is just about less than 5%. So usually it is about 2 to 4% maybe. Okay, and let's see how much the price has advanced, about 12%. So this is 3 to 1 profit to loss ratio. Okay, so it is happening again here. As we can see, it is happening again here. The price didn't break the 50 days moving average. That's why I explained to you at the beginning that you just imagine every simple moving average 7, 10, 20, 50 or 200 is a stack of paper of each other. 7 is 7 layers, and 10 is 10 layers, and so on. So 50 layers, 50 days moving average is about 50 layers of paper. If you want to stab the knife through the 50 layers of paper, it's hard. Okay, it's hard. That's how the price usually hard to break the 50 days moving average, and it tends to bounce back if the momentum is still strong. Okay, this is a very good example, very good opportunity. Okay, so you can see around here the price already moved up from the 50 days moving average already 5.9%. Same goes to Cisco. Okay, Cisco, if you can see here the first, let me delete all of this first. At first the price bounced back on 20 days moving average, but around last year the overall market's not really good, so the price ranging and break the 20 days moving average, but still the price cannot break the 50 days moving average around here. The price touched the 50 days and then bounce back and close above the 50 days moving average, and then just shoot up straight. Okay, it's already 6.4%. okay, that's how you use simple moving average as your support line, and where to put your stop loss. The next example we can see here at Wingstop during the price move last year. Okay, you see for 50 days moving average it bounced back, and during the fastest growing pace for this stock, the price didn't break the 7 or 10 days, so it come close to the 7 and 10 days moving average, and then it's bounced back. Here it always move along the 7 days moving average. Okay, all right, this one bounced back on 20, so it is a very good indicator for to enter our position, and I will usually use every one of it, depend on how the stock move. Okay, the faster the stock move, the lower moving average it will touch. Okay, so for 200 days moving average, I don't have any example around here, but usually the price is quite hard to break the 200 moving average. Okay, if the price goes down the 200 days moving average, usually it will goes back. But if it breaks the 200 days moving average, just leave the stock, it will go even lower. Okay, thank you for watching. I hope you guys learned something from my video. Subscribe if you haven't. Please share to your friends who maybe this is valuable to them. Maybe this can be benefit to them. Okay, I will post again in the next few days. I will explain a little bit more on maybe different stock analysis. Thank you for watching. I hope this will give you an idea how to use the moving average. Okay, in this example, I'm using simple moving average, and I always use simple moving average. I'm not using EMA, which is exponential moving average. Thank you for watching. Please like and share and subscribe. I really appreciate you guys. Hope to see you in the next one. Thank you so much.